Hello and welcome to the Weekly Forex Outlook at xm.com. Next week, dollar traders will be sure to keep their eyes on the U.S. jobs report, as well as ISM manufacturing and services PMIs. In addition, Eurozone inflation data will be released, which will be important for the ECB's next moves. I'm Maria Vachardez, and joining me is lead market analyst Rafi Boyadjian. So Rafi, back in July, the shock from the non-farm payrolls data created a lot of volatility in the markets. What are we expecting this time from the August jobs report due out on Friday? And how is it likely to impact the Fed's next moves and the dollar?
Well, Maria, indeed, the last jobs report was very crucial because it's pretty much what led to the Fed pivoting towards a more dovish stance. We heard Powell at the Jackson Hole signaling a rate cut potentially in September. And if we have a look at the July data, it wasn't so much the miss in the headline payrolls number that was the big shock. It was more so the significant downward revisions we saw for both the months of May and June. On the overall, it seems that in the last few months there was a very significant slowdown in the US jobs market, which the Fed hadn't previously was aware of. And so potentially the Fed is now saying that the downside risks to the labor market are somewhat greater than the upside risks to inflation, even though, of course, we still have the threat on inflation from the higher tariffs of the Trump administration. So the August jobs report is going to be very important to see, of course, whether there was any improvement during the month in terms of jobs creation, and also what's happening to the unemployment rate. Now, of course, the other controversy that arose from the July jobs report was that President Trump didn't like the data, and he fired the head of the Bureau of Labor Statistics, accusing the department of basically rigged data, inaccurate data. Now, of course, there is some truth to those accusations, but this is something that's probably going to take some time to rectify. So probably we're not going to see any significant changes in terms of how the data is calculated for August. So we do have these question marks about how reliable is the data. And it might turn the attention slightly more towards the unemployment rate, which uses somewhat a different survey, because the payrolls numbers that's used the establishment survey, which is separate from the survey for the unemployment rate. So that might be a more reliable indicator going forward, and we are expecting that to tick up to 4.3%. And so if we see a gradual increase in the jobless rate over the coming months, we may see the Fed potentially becoming even more dovish, even more concerned about the labor market. Now, as for the non-farm payrolls change, we're anticipating a figure of 78,000, which would be a slight improvement over the 73,000 we saw last time. But of course, we have to also pay attention to the ISM PMIs. So these are coming ahead of the jobs data on Friday. We're going to get the manufacturing PMI on Tuesday and the service on Thursday. So we're likely to see quite a bit of volatility during the course of the week. Now with the PMIs, the main numbers haven't been too bad, particularly services, which again, like a lot of the other data, shows the economy overall remains fairly resilient, but we had been seeing the prices index rise both for manufacturing and services. So we are seeing some impact from the higher tariffs come through. And should we see these price indices remain elevated, again, it's going to basically support the argument for the Fed to move cautiously rather than react very strongly to any weakening in the jobs data. So the dollar potentially could come under renewed pressure if we see overall weak set of data, or data that's kind of much weaker than what we've been seeing recently. But any upside surprises, of course, would probably lead to a bit of a relief rally for the dollar. So I think it's going to be an interesting week.
Turning to Canada now, it did not receive an extension on the 25% tariffs on the goods not covered by the US-Mexico-Canada agreement, and it imposed counter tariffs on US imports. Can you give us an update on what Canadian Prime Minister Mark Carney has recently announced, and how the upcoming data may impact the Bank of Canada's next moves and the loonie?
Yes, so we've seen quite a differing approach between Mexico and Canada. Of course, both nations are part of the USMCA agreement. Both nations have come under attack from Trump for, taking advantage of the US. Mexico, though, has kind of tried to not escalate the situation even more than it has. Canada, on the other hand, has retaliated, and that's why they announced counter tariffs, which now Mark Carney is having second thoughts about, because the negotiations with the US haven't really gone anywhere. And in fact, Mexico managed to win an extension for 90 days, a further extension of 90 days, whereas Canada didn't. And they saw their tariff level rise from 25 to 35%. So Carney is hoping that by moving some of the counter tariffs, it's going to, basically signify gesture of goodwill towards the Trump administration and boost the negotiations, potentially lead to a positive outcome. Now, we don't know whether there's going to be any update on those negotiations next week when some of those tariffs are removed on September the 1st. But of course, any positive development there would be quite positive for the Canadian dollar. Now, in the worst case scenario for the loonie is that if we see those tariffs being removed, which would lead to lower prices for Canadians on a lot of goods imported for the US, and then we don't get any update just yet on trade talks, but then we also get the jobs report on Friday, where we see weak set of numbers that would likely boost expectations of the Bank of Canada cutting rates again sooner rather than later. So that's something to consider.
And finally, over in the euro area, inflation seems to have stabilized over the past few months. The flash CPI is due out on Tuesday. What are we expecting? And do you think the data will confirm an ECB pause?
So the ECB has been quite clear in saying that they're going to stay on pause, at least for the September meeting. Now, a lot of people are saying that the ECB will have to cut rates again at some point because of the economic impact from the higher US tariffs. And although the EU and the US have reached a trade deal, it wasn't quite the deal that Europeans were hoping for. So there's bound to be some impact, even if further talks lead to further reduction in some tariffs, for example, for the car sector. But on the whole, there's a bit of uncertainty around the outlook. But for now, I think the ECB can afford to stay on pause. Even though inflation has been quite stable, we're expecting to see the headline figure stay unchanged at 2%. The core numbers have also steadied slightly above 2%. So overall, it's looking very positive on the inflation front. But, we still have some price pressures on the whole. Despite all the negative headlines, the European economies haven't been doing too badly, apart from Germany, of course. We've seen fairly decent growth in the first half of the year, and wage pressures actually ticked up in the second quarter. So this is a little bit of concern for the ECB, which is why they might decide to stay on pause and wait a bit before resuming rate cuts, if they resume rate cuts at all. But on the whole, I don't think we're expecting any significant reaction in the euro. Potentially what might matter more for the euro if we see any spike in Eurozone bond yields, for example, some negative developments, fresh turmoil in France, for example, where the government is under the government coalition is under threat at the moment.
Rafi, thanks so much. This was the Weekly Forex Outlook here at XM.com.